bank-produced money by the commercial banking system is at 6.8%, not 4.5. It's over the golden growth rate. I think it'll probably go up to like 10% or something like that.
10% M2 money supply year-over-year growth. What does that imply for inflation?
It would probably be something like...
Why is the yen even depreciating against? It should be appreciating against the dollar because the Bank of Japan's raising rates.
The reversal of the carry, and the reversal would occur if for some reason the yen starts appreciating against the US dollar.
So if the yen were to appreciate, presumably against the USD, right, we're going to see the bar chart go down here. Let's assume this relationship holds. We're looking at the S&P falling off.
You're making a good point. You're making a good point.
Steve Hanke returns to the show. He is a professor of applied economics at Johns Hopkins University, expert on global currencies and monetary policy. We'll be talking about the Japanese carry trade. What is it? How has it been impacting bond markets and potentially equity markets? And what a reversal of the Japanese yen carry trade could mean for global equities and U.S. equities in particular. We'll find out with Professor Hanke. We'll also be going over today's PCE report that came out on the morning of December 5th. So we'll go over inflation and what the Fed's going to do next. This episode is brought to you by Kalshi, one of the largest prediction markets in the U.S. It is a fully regulated platform that lets you trade on real-world events from economic data and news to political outcomes. So go to Kalshi, link down below. Kalshi.com/r/Lin, or scan the QR code here. Use my promo code LIN, L-I-N, and new users using my promo code will get $10 when they deposit $100. Professor Hanke will also be going over a few predictions on Kalshi today, and it'll be a very interesting episode. Welcome back to the show, Professor Hanke. Good to see you as always.
Absolutely, David. Great to be back with you.
Yeah, the 10-year bond yield in Japan rose to the highest level since 2007. And here in the U.S., bonds have been selling off aggressively over the last week as well. People have been linking these two issues. Well, we'll find out. We'll get your take on that in just a minute because it's top of mind for a lot of people in the investment community, and people are very concerned about this, and it's trending all over the news right now. Let's start by talking about today's PCE report in the U.S., though. So headline PCE rose 0.3% month over month in September. It's now, the annual rate's now at 2.8%. Core PCE, excluding food and energy, dipped slightly to 2.8% annually. So more or less, this is in line with expectations. However, it came down a little bit from the previous month, the core PCE, and we know that the core PCE is watched by the Fed. So I want to get, in this segment of the conversation, I want to get your outlook on two things: inflation itself and what the Fed's going to do.
The first thing is that the new September report is kind of a nothing burger. Nothing really changed. And remember, with those numbers that you just reeled off, we've got inflation considerably higher than the Fed's inflation target of 2%. And I don't think that the Fed is going to be able to get the inflation genie back in the bottle this coming year. I think that's my main takeaway from what's going on. You ask about the next week's December 10th Federal Open Market Committee meeting, and it looks like a 25 basis cut in the Fed funds rates baked in the cake. The probability at the Chicago Mercantile Exchange is running, close to 90%. So it's pretty much a done deal. Now, that's loosening, lowering the Fed funds rate. That's loosening. Another factor that's loosening in the picture, as I see it, is that in April, the supplementary liquidity ratio will be dropped on commercial banks. And remember, commercial banks actually produce most of the money in the United States. Money measured by M2, about 80% of that is actually produced by commercial banks, not by the Fed. So that removing that reserve requirement, that liquidity reserve requirement on the commercial banks will give them quite a bit more firepower. In fact, a lot more, maybe $2.5 trillion worth of extra capacity, meaning that loans, the rate of loan growth we can anticipate credit expansion. And as that credit expands, of course, that means that the money supply expands and accelerates. So that's the second loosening factor. The third loosening factor has come into play this month, and that is the Fed has dropped quantitative tightening. And the Fed has actually been involved in tightening, quantitative tightening, reducing the size of its balance sheet, and actually making a negative, recently it's been making a negative contribution to the money supply growth, the Fed. So although the commercial banks are contributing at a fairly rapid rate, actually, the Fed has actually been a non-contributor. They're subtracting from the money supply growth. And then the fourth factor is we have the fiscal deficit in the United States running, 6%, a little over 6%. And that's being funded very heavily now with the issuance of treasury bills with less than 1 year in duration. And those have been vacuumed up by money market, mainly by money market funds. And that vacuuming increases the money supply. So you've got four loosening factors in the picture. One, Fed funds rates going down. Two, I just mentioned quantitative tightening has been dropped in December. Three, a big one will be in April when this supplemental liquidity ratio is dropped. And then four, we've got the fiscal deficit coming into the picture, and it's being financed with the issuance of treasury bills, short-term treasury bills, and those have been vacuumed up by money market funds, and that increases the money supply. So the deficit is being monetized. Part of the deficit's being monetized. So that's the fourth factor, all leading to an increase in the rate of growth in the money supply, and that will eventually mean more inflation in the picture. So that's the inflation picture. Right now, we're stuck with an inflation. The CPI, by the way, is at 3%. These core numbers you gave, the year over years are what? What did you give, David? 2.7 and 2.8. So those all the numbers are stuck above the target rate of 2% right now, and it looks to me like we are probably going to be in a loosening stage, a credit expansion stage in the United States, and that will eventually give us even more inflation. Now, this becomes a political issue because this affordability issue has really gotten some teeth, and people know that if when they go to the store, they're paying more than they were a year or so ago, or certainly more than they were in 2020 before the whole thing started taking off. And we've got what's called money illusion going on. They pay attention not to the real inflation adjusted values. They look at the sticker, the nominal prices on things, and they say, God, I'm paying a lot more now. It is unaffordable. And the shoe seems to be dropping on Trump. They're blaming Trump for this. So this all of this inflation story factors into the political story. And remember that my contention is that the Fed is flying blind. It's not it watches data. It's data dependent. But the only thing that's important to be watching is the money supply, and the Fed doesn't seem to watch it. They watch everything under the sun, the PCE numbers that we just talked about, the CPI, the unemployment numbers, and all kinds of things, manufacturing activity, all of those things they watch, but they don't watch the money supply, which is the only thing that counts.
So, Professor, before we continue, let me just pull up. I have a lot of follow-up questions on that. Let me just pull up the money supply. So you and your colleague, Mr. Greenwood, have been spot on in calling for inflation to go all the way up to 9.1% at its peak a couple of years ago, and then all the way back down. You called the bottom, and you basically called the range, so it was a perfect spot-on prediction over the last couple of years. However, you've been on my show a lot talking about inflation, and you've been consistently saying that inflation will not be a problem until the M2 money supply growth rate reaches your golden growth rate of 6%. This is the first time I've heard you in a long time sounding the inflation alarm bell, which is a 180-degree turn from your stance from just earlier in the year, Professor. And importantly, the M2 money growth rate is not yet at 6%. So why the change?
Well, you heard it first on the David Lynch show. That's the one thing. You pick up on things pretty fast. And this is a first-time announcement of my concerns. And my concern, okay, right now the year-over-year rate of growth in the money supply is 4.5%. That's lower than the 6% rate that's consistent with hitting a 2% inflation target. But if you look at the thing, it's accelerating, number one. And if you look actually at the bank-produced money, the bank-produced money by the commercial banking system is at 6.8%, not 4.5. It's already increased, and it's over the golden growth rate. And I said, with that supplemental liquidity ratio coming off in April, that means that that's gonna go up. I think it'll probably go up to like 10% or something like that. So that we're at a turning point. And I'm anticipating, I'm kind of getting out ahead of the thing a little bit. But as I look at the tea leaves, David, the tea leaves are telling me that everything is pointing towards a loosening of the monetary policy, and that will lead to an acceleration in that M2 growth rate that you just had up there at 4.5%. So that's what's worrying me now. If you ask me what's keeping me up at night, well, not much does. Actually, I sleep like a baby. But to use that proverbial phrase, what's keeping me up at night or making me worry in the daytime is what I think is going to be a loosening of the money supply that will be excessive, and it will give us more inflation. And certainly it won't lead to a reduction in the PCE numbers that we just went over, getting those down to 2%. I don't think that inflation genie is going to be put back in the bottle at 2%. That's the bottom line. The big message is 2 points. One, the inflation genie has not been put back in the bottle at 2%. We've already gone over that. And two, looking ahead, it looks like they're going to be loosening even more, and that will give us more inflation, not less.
Professor, let's take a look at who's going to be the next Fed chair, and potentially that may impact monetary policy or change or support what you just said. So prediction markets, I know you like to look at prediction markets. This one's from Cauchy. It's one of the largest ones in the U.S. Kevin Hassett is predicted by traders as the front runner to be nominated as Fed chair. So let's assume the market's right on this. Kevin Hassett's going to be Fed chair. What do you think? Is he going to support the loosening monetary policy that we just discussed?
Yes.
Okay.
He's a Trumpist. He's a Trump man, and Trump wants the Fed funds way down, much lower than they are right now. And Hassett will lean into that direction. Now, by the way, the prediction market was very interesting because if you look at that thing on Monday, it looked like Hassett was a shoe-in. He was over 80%, and the bond market sell-off. Part of that, forget Japan. It was spooked because the bond market saw Hassett as being a loose money guy, and a loose money guy means more inflation. More inflation means higher yields and lower bond prices.
Okay, that makes sense. Well, let's just see how the prediction markets are predicting rate cuts here. Rate decision in December. It's looking at 94% chance of a 25 basis point cut in the next rate cut decision. We'll have you back on after the next FOMC meeting to evaluate this, but it looks like that's basically a done deal. 25 basis point cut. The question is, what's going to happen in 2026? Fed cuts in 20. I wonder if they have this here. Number of rate cuts in 2026. There we go. The prediction markets are kind of split on this. Exactly 2 cuts, 25%. Exactly 3 cuts, 24%. So there isn't an overwhelming majority on any one particular outcome yet. I don't know. What's your view?
But well, there is one overwhelming outcome, and that is that we're going to get cuts in 2026.
You're right. Yes.
And the question is, well, how many are we going to get? But well, let's worry about that later.
Well, do you think we'll get more cuts with Kevin Hassett than with Jerome Powell?
Yes.
Okay. Well, I guess that sums up our thesis for loose monetary policy, and the QT, like you mentioned, has ended. And don't forget that taking April is key, because April is when that liquidity reserve, supplemental liquidity reserve ratio comes off, and the banks will have much more capacity to loan. And right now, the contribution, the rate of growth and the contribution of commercial banks to the money supply measured by M2 is 6.8%. That's already over Hanke's golden growth rate of 6%. So the commercial banks are already extending a lot of credit, and after April, they certainly will have more capacity to even lend more. And I think that number probably will go up. My guess is, this is just a guesstimate, it could go up to 10%. Yeah, that's what you said earlier. So let me ask you about that, because that was my next question. Perfect segue. 10% M2 money supply year-over-year growth. What does that imply for inflation? Have you done a back of the envelope calculation on that?
Yeah, let's do it. Let's do it right now, just off the top of my head. So the 6% figure has 2% is accounted for by the increased demand for money, and let's say 2% real economic growth. So you've got 4% that we have to subtract from the 10% number that you gave to get inflation. So I'd say, it could go up to, 5%. I'm not predicting that. That isn't a sharp pencil kind of thing. You asked me what off the top of my head. And I'm just saying, off the top of my head, under that scenario, if M2 was growing at 10%, if that occurred, then the implied inflation rate associated with it would probably be something like 5.
Well, we can and
you get that. The arithmetic of that is pretty easy. You have M2 growing at 10%, and you have to subtract out a real growth of at least 2%, and also subtract out a 2% rate of growth in the money supply, soaking up that part of that 10%. So that you subtract 4% from the 10, and you get 6. And I adjust it down a little bit and just say keep it conservative at 5.
I mean, that's in line with backtesting this. So if we backtest this, and let's say in February 2021, when inflation was peaking at 9.1%, the M2 was growing at a peak of 26.7%. So it's 26% M2 growth year over year implies, or implied past tense, 9%, roughly, let's say round up to 10% inflation for the sake of argument. And then if you divide that by roughly 2, that's roughly 5. So that's another way to look at it, I guess. Okay, well, let's see if that happens.
If you're looking at the quantity, using the quantity theory of money, which you should be, MV equals PY. If you're using that equation of exchange to do your arithmetic and figure out things, you can roughly do some of these back of the envelope calculations that we've just done. So the people who are watching us, if they're at home, they can get a piece of paper and a pencil and figure the thing out and get, more or less a feel for what's going on. Let's put it that way. Now, unfortunately, the Fed isn't doing this, David. That's the whole point. They are not looking at the equation of exchange, MV equals PY. They do not look at that. And they're not looking at M, the money supply.
Okay, well, I think that concludes our conversation about inflation and the Federal Reserve. So if you have any questions for Professor Hanke, please do submit them to us. Email down below, link down below, click on the description or go to the description. I'll put the email for Professor Hanke and myself. So please email us. We have been getting a few pretty good questions, I think, directed to you privately.
We have very astute viewers who give us good questions. So the one thing,
my viewers are very smart.
Let me summarize the inflation story that we're talking about. Is that as you said, I was kind of on a green light, and now the light has turned to kind of a flashing yellow. It's not red yet, but it's definitely yellow.
What would turn it red for you?
If these things that I anticipate happening with monetary policy actually do happen.
Well, what's the lag there? So let's say once these things in monetary policy actually do happen, then how many months afterward can we expect inflation to start picking up?
Since it's so sticky right now, it probably a shorter lag than normal. The normal lag is about 12 to 24 months.
Okay.
That's a normal, but it could be less than 12.
Okay.
Remember the famous Milton Friedman line. You have long and variable lags between significant changes in the money supply and changes in inflation. So the lags are long and they're variable. So it's very hard to put your finger on exactly what's going to happen. But my guess is, given the current environment, that the lags will be shorter than the 12-month.
Well, one thing to note is that the M2 growth has been rising concurrently with CPI growth over the course of this year, 2025. So maybe that's been a coincident indicator throughout this year. Let's move on to the bond market now. So the bond market, like you said, threw a hissy fit, not because of the Japanese yen carry trade, but because of Hassett. But we can look at the yen carry trade regardless. So this just came in from a couple of days from Bloomberg. The yen to strengthen 10% in coming months on U.S. rate cuts, says Morgan Stanley. The yen looks set to appreciate by nearly 10% against the dollar in the coming months, yet the Federal Reserve delivers back-to-back rate cuts. We just talked about that. The dollar yen is detached from fair value now, and if that relationship returns, the cross is seen declining in the first quarter of 2026. Japanese fiscal policy is settings, meanwhile, are not especially expansionary, they said. So that's one narrative. The other thing to consider is, of course, that the U.S. 10-year bond yield has been rising. It's now actually today, it's up 60 basis points, which is a big move in one day. And people are assigning all sorts of reasons. But tell us what's happening with the Japanese yen, the carry trade. What is the carry trade? Explain to the audience, please, and why it is we should be concerned about this. Part of the reason we're talking about this in the first place is that, like I mentioned in the very beginning, the Japanese bond yield, 10-year bond yield, is at the highest level in more than 15 years.
First, let's back up and define what the so-called Japanese. There are all kinds of carry trades, but the one in Japan is the most significant one because the money supply has been growing at a very slow rate for like 30 years in Japan. So interest rates, nominal interest rates, are very low in Japan, and that means that you can borrow at low interest rates in Japan. And when you borrow at low interest rates, you're short the yen. Okay, you borrow in yen at a low interest rate, and you invest someplace else at a high interest rate. And typically, what's happened over the past several years, one of the favorite carry trades was the Japanese yen, Turkish lira. And then it moved from the lira to the Mexican peso. That was popular for a while. And now the U.S. dollar, of all things, is the biggest Japanese yen carry trade. So you borrow in yen, and now the 10-year bond is about 2% in Japan, and actually an 18-year high, and the 10-year U.S. is about 4.2 now. So you're borrowing at 2% in yen and investing at a little over 4% in the United States. Now, So that's the carry. Now, the risk of the carry is the thing that you just went over, that the Bank of Japan will increase its interest rate, and that will strengthen the yen. And if you strengthen the yen and you've borrowed against it, and you're short the yen, you're going to lose. So that's the risk. The risk that the yen is at about 155 now. It's been depreciating. So that's allowed the carry trade to work. You not only have made money on the spread between borrowing low in Japanese yen and investing higher in the US dollar, but you've also been making money because the yen has been depreciating against the dollar. So if you have an unhedged carry, you've been making money in the spread and you've been making money in the exchange rate. Now, the worry, the panic everybody is in, is that the governor of the Bank of Japan has pretty much indicated that he's going to raise the interest rate to strengthen the yen and fight their little blip up in inflation that they have in Japan by strengthening the yen. And if that yen would appreciate, as you just reported, if it would appreciate by 10%, of course, you'd lose your shirt in the carry trade. The spread you're making would not cover the loss that you're going to be making on the appreciating yen. So that's what's going on with the yen. Now, it happened coincidentally, by the way, when the 10-year JGB went up and hit an all-time high earlier this week. At the same time, you had a sell-off in the 10-year U.S. Bond, and they were correlated, but correlation, of course, doesn't imply causation. Yeah. I don't think there was any causality going on here. I think the main thing on the U.S. 10-year was a concern over what I just told you and we talked about in the inflation story. The bond vigilantes are getting nervous, basically. And they're getting nervous because it looks like Hassett will go in as chairman of the Fed, and he'll probably be a loose money guy relative to Powell. And it looks like, by the way, the Fed in general, the members of the Open Market Committee have had their arms twisted so much by the White House and Trump that they're coming around to this loose, lowering Fed funds. So that's the nub of it. I might add, David, that if anyone really is, the carry trade's very important, because what happens in Japan is that the public sector, they have a debt to GDP ratio over 200%. So they have a huge dis savings in the public sector, but the private sector has a huge over savings, in the sense that savings exceeds investment in the private sector by a huge amount. If you add them both together, they have a surplus of savings relative to investment in Japan, and that's the source of the carry. That's the fuel. And so they export capital. The carry trade is nothing more than the Japanese exporting all this excess savings they have and exporting capital to the rest of the world. When you engage in a carry trade to the U.S., where does the Japanese capital go? It goes into the U.S. If you do it with Mexico, it goes to Mexico. If you do it with Turkey and the lira, it goes into Turkey. Now, the definitive book on this, by the way, is written by a good friend of mine, Tim Lee. Here it is.
Yeah.
For your audience, anyone who seriously wants to get into this topic, which happens to be very important in looking at international capital flows and what's going on, read Tim Lee, The Rise of the Carry. He wrote that, by the way, with one of his co-authors is his son, Jamie. three authors, but that's the book. If people are really serious about drilling down into the thing, McGraw-Hill publisher, you can get it on Amazon.
The concern, and I'll pull up some stats later. The concern is that as capital leaves Japan, and I'm about to find exactly how much capital has left Japan. So it goes back into Japan. I'm not leaving Japan. Goes back into Japan because rates are going up in Japan. That will lead to a sell-off in equities markets in the United States. I don't know how much capital is parked in the U.S. that Japanese investors, institutions have had that are probably going to be unwound and put back into Japan as yields are more favorable in Japan now. I'll let you comment on that.
Okay, so here's the way this thing, it gets in kind of a doom loop, and the unwind. How would that happen? The unwind. I said the major risk is the appreciation of the yen. So let's assume that the increased interest rates that the governor of the Bank of Japan promises actually strengthens the yen, and the yen gets strong relative to the dollar. Well, that means everyone involved in the carry is probably going to lose a lot of money, and they'll start unwinding the carry, and they'll unwind the hedges that they have on the yen. And as they unwind these things, it just makes the yen even get stronger relative to the U.S. dollar. And of course, the ultimate thing is the outflow of capital that's come in, these short-term capital movements that have come in with a carry, they will go out. The tide will go out. And, as Warren Buffett famously said, when the tide goes out, you're going to see what people are wearing. So
isn't it interesting though that given the interest rate differential, the Fed lowering rates, the Bank of Japan about to hike rates more, the dollar has been strengthening against the yen in the last couple of how does that make sense?
And what they're worried about is the 160 level is the key. If the yen would depreciate and go over 160 to the dollar, that's a very key resistance point.
But how does this even make sense? Why is the yen even depreciating against? It should be appreciating against the dollar because the Bank of Japan's raising rates, interest rates are going up in Japan.
The carry trade has something to do with this because the market is shorting the yen. They're borrowing in yen to enter the carry trade and invest in the U.S. dollar. So the carry. If you have a carry-on that's unhedged, you're going to be short the yen.
I see.
So the carry, the key thing that we're talking about, and the reason you brought this up to put words in your mouth is the concern that people have about the reversal of the carry. The reversal of the carry. And the reversal would occur if for some reason the yen starts appreciating against the U.S. dollar. So the carry trade it's like picking up, as they say, it's like picking up pennies in front of a steamroller.
Well,
you see what I mean? If the steamroller hits you, you're reversed.
You look at this, right? You look at this chart. I've got here the S&P 500 in the blue line, and then the USD to yen in the bar chart here. So as you can, again, to quote yourself earlier, correlation is not causation. We know that. There is a very stark correlation between the yen, the dollar yen, and the S&P 500. So if the yen were to appreciate, presumably against the USD, right, we're going to see the bar chart go down here. Let's assume this relationship holds. We're looking at the S&P falling off. So that's just an extrapolation. I'm not saying that's going to happen. I'm just looking at this chart. So first of all,
you're making a good point. You're making a good point with this. And the point, let me elaborate slightly. The market, the equity market in the United States is in a bubble. Every bubble detector, including Hanke's Dr. X's bubble detector, it concludes we're in a bubble. And what you never know is when and how the bubble is going to deflate. Is it going to pop? Is it going to just slowly dissipate? And you're going through an important thing people have to be watching, and that's the Japanese yen against the dollar. Because if that yen starts appreciating, they'll unwind. You'll have a huge carry trade reversal, and if you have a huge carry trade reversal, you get a lot of money coming out of the market, and maybe that would be the thing that would pop the bubble. You see what I mean, David?
Yes.
Yeah, that's why it's important to put up those charts like that. We know correlation doesn't imply causation, but you put up that thing, and my takeaway from that, which I quite frankly I'll admit I hadn't thought about it, is that it's a bubble popper. If you reverse the carry, you've got a potential bubble popper.
Let's keep tabs. I mean, can you explain this correlation that we've observed? Why was the strengthening of the USD versus Japan correlated with the S&P? Maybe it had nothing to do with Japan itself. Maybe it's just capital flowing into the U.S. But can we explain?
Well, the carry, the Japanese carry. Number one, the Japanese carry to the U.S. is the biggest Japanese carry right now.
Sure.
And that means there's a lot of capital that's come in from Japan into the United States. And what does that mean? Well, it means at the margin, it's got to be fuel for the bubble. It's inflating the bubble. And if you reverse it, maybe it pops a bubble.
Okay. Well, besides that, what other risk are you looking at for U.S. equity markets?
It's kind of a long list.
Give us your top 1, 2 or something. I don't know. Well, make it easier for us.
Yeah. Well, let's leave it as follows. One risk, by the way, is the carry. That's we just talked about. But let's look at the other side of the thing. What did we talk about earlier? A loosening of U.S. monetary policy. So that would be pumping air into the bubble, and the carry coming off would be taking it away. So we have a perfect illustration of the kind of uncertainties that are facing us right now. We've just done 2 big ones.
Yeah. Okay. Well,
and they're going in opposite directions. So that's the kind of thing that actually does keep people up at night. So what do you do? What do you do? Well, the only thing I can say is that I wouldn't say get out of the market, get into the market, whatever. I'd say rebalance your portfolio. Look back at where you were at some starting point, maybe before COVID. Let's assume you're 55 years of age and you've got a standard portfolio of 60-40. Well, that portfolio with this bubble increase in the equity market certainly isn't going to be 60-40 anymore. It's going to be more like 85-15 or something. So my advice would be, in these kind of uncertain times, it's always probably wise to take a look at your portfolio and rebalance it a little bit.
All right, good. Thank you very much, Professor. We'll end it here for today. Where can we find you?
You can follow me on X at Steve_Hanke. Or you can just write me if you want to be on my weekly distribution list, and that it would be just my email, hanke@jhu.edu.
Okay, good. Thank you very much, Professor Hanke. Don't forget to follow Steve in the links down below, and make sure to write to us in the emails that are also in the links down below, or just put in the comments down below what you would like us to talk about next time. Professor Hanke will be on again in a couple of weeks, so stay tuned for the next episode and do contribute your ideas. And again, do use my promo code LIN, L-I-N, when you sign up to Kalshi. That's kalshi.com/r/LIN, link down below, or scan the QR code here. You'll get $10 in your first $100 deposit.